In this episode, Cory Bearden, Senior Vice President of the Construction Division at Luminate Bank, joins to share how, in just a few months, he and his team have expanded their program from lending in just 4 states to over 46. Cory shares his insights on what it takes to scale a construction program, from managing risks and building the right team to leveraging technology for success.
The very first thing you have to do if you want to be in this space is, kind of define what type of construction lender you want to be and where will your organization allow you to go. What resources do you have to support it? Builder fails, how do we step in and help? If the borrower fails, how do we step in and help? I attribute that all the way back to our residential construction loan agreements that we put into place right off the bat. Construction programs give the loan officers the ability to go out there and build additional relationships they might not otherwise have with builders and realtors and borrowers.
I'd like to welcome everybody to the Construction Lending Podcast. I'm your host, Sean Ferris with Land Gorilla, and today we've got a special guest for you, Cory Bearden, Senior Vice President of the Construction Division at Luminate Bank. Cory, welcome to the podcast.
Thanks for having me, Sean.
To the more important stuff about construction lending and what you guys are doing over at Luminate Bank. You guys are growing a program, starting a program. Give us a little background on what you guys got going on.
Yeah, you bet. I'm happy to share with you guys. I had an opportunity to come join the team at Luminate Bank back in February of this year. And, very progressive bank with a mortgage-centric, focus in growing the bank itself. And so a part of the mortgage division was to grow a construction division there. It was already implemented at the bank. Luminate Bank already had a construction division in place. And as a part of that conversation with the owners of Luminate was to step in and then bring some of the knowledge and programs and best practices and then grow it from essentially a regional lending bank of 4 states where they were lending in construction to we've taken it to over 46 states now since February. So it's been a lot of fun. And
that's a big jump.
It was a big jump. Yeah.
That's a big jump. How's that going?
Well, I can tell you, obviously construction lending's not for the faint at heart, I promise you, so it took, it was actually a lot of fun, Sean. We had a plan and a focus. We put the right people in the right seats to help support the construction division from operationally, from construction administration to construction loan specialists that work with our retail loan officers through every transaction, loan policies, procedures, just implemented the program the right way and then grabbed the right technology to help us do that through Land Gorilla and manage that construction administration piece. So it is a large jump, and the design for our construction division is to support our residential loan officers out there. We have a little over 400 residential loan officers nationally, and that can now use the construction programs that are all in play at Luminate Bank, from FHA to VA to conventional one-time closes to our traditional 2-time close interim construction loans.
Yeah, no, this is really interesting because, we have, what I would refer to as backyard lending. Hey, you really know this county or city or, multiple cities or, everything within your state, right? You got statutory requirements that sit within that state, and transitioning, an organization from that really close backyard lending where you could just drive and look at everything if you wanted to, hey, we've got to depend more on third parties. We've got to have inspectors in these areas. We got to understand what the legal implications are. Do they have specific lien waivers? What's that for construction lenders that are looking to expand or to move more towards a national model like this? What are some of the challenges that you have to overcome to be able to do this?
Well, I think you hit it spot on. I think the very first thing you have to do if you want to be in this space is kind of define what type of construction lender you want to be and where will your organization allow you to go. What resources do you have to support it? If you're going to be a lender and there's no right, wrong, or reason for any lender in the way they prefer to do it, it's all based upon your risk that you're willing to take. Do I want to be a lender that just lends in one state and one county or city or one area that I'm comfortable with? Maybe it's a local credit union, right? Could be an IMB that wants to lend in multiple states, depending on their footprint and where they're licensed, right? Or do you want to be a bank, a mid-sized bank, a large bank, a small bank that wants to lend regionally in 4 or 5 different states? Whatever your comfort level is, I think that's the number one starting point, is to say, okay, where are we comfortable operating? And then if we're comfortable operating like Luminate Bank is on a national basis, do we have the right people doing the right jobs to be able to support it, and have a plan in place to be able to then grow gradually, control growth within your limits that you have available, and have all the technology and the compliance that you need to go be successful. And I really think that's where you got to start, is defining what kind of construction lender do you really want to be.
Now that sounds real. I could hear my dad talking in my ear right now. Risk management policy statement, and getting it down on paper where, hey, we're going to do this and we're not going to do this. Like, it's equally important. I can hear him saying it. It's equally important to define not just what you're going to do, but what you're also not going to do. Mm-hmm. And getting others to commit to those things, getting buy-in from the entire organization, from the top down, board down, of, hey, here's what we're going to do, and here's also what we're not going to do. And that sounds like it's the approach that you guys took as well. Any lessons that you've learned kind of in a national rollout like this? I mean, 400 people, 400 originators is a lot.
I think there's always, anytime you implement a new program, there's going to be bumpy roads that you travel down, right? And I think that you have to kind of reach back into your past history and identify the bumps and bruises and black eyes and bloody noses that you might have obtained along the road, and say, okay, those worked for us and those didn't, right? And for me, I relied on some mentors that I worked with in this industry over the years that really, kind of spoke to me about certain pathways that you want to go. You want to do construction, you want to maintain your risk, you want to help as many as you can. And we focused on high LTV, low down payment construction programs using the agency programs, whereas for some, that risk, it may be too much for them to take. So, kind of relying on your background and your history and where you can go, and having the right tools in place to facilitate from origination to modification and all the little pieces in between. They're all going to drive their own nuances, right? And so I feel like I had a great opportunity to spend 21 years at a previous organization that was very much like the organization I'm at today, and see that grow from an IMB to a national bank with a good construction lending program, and was able to take some of that knowledge and then leverage that, saying, okay, here's how we're going to do it, and we're going to implement this in the next 60 days. So we started in February and took the existing construction division there, which was already strong in doing what it was doing on interim construction loans, put policy, procedure, technology in place, working with your team, and then supported it with the agency programs. And we launched at one of our sales events in April 1st, and then we closed our first loan April 8th. So we started in February, closed our first loan April 8th. And so
that's fast.
Been going really well since then. So, yeah.
I mean, that's really fast. Usually it's a little bit longer than that. But you mentioned a mentor, and one of the questions that I always love and find fascinating about this is how people get to where they are. It's not like there's a course track in high school or college that says, hey, construction lending. There's no such thing. And, when we get into people's origin stories, it usually starts with, getting acquired, or somebody walking into your office saying, hey, we closed a construction loan, I need you to manage it, or, some sort of kind of surprise event. But you mentioned a mentor. How did this all happen for you?
Well, and it probably really started back in 2013. I got to work with a gentleman that was a banker for 45 years, and he had a lot of experience. And in that situation, you just become a sponge, and you listen a lot, right? And as you start implementing programs, they're going to have thoughts and theories on the right pathways to follow, and a lot of stories of this is why you wouldn't want to do that, or a lot of stories why, yes, that makes sense. And so that's really what my main focus was listening to those that made an impact around me and giving me their knowledge and sharing with me. And then I just kind of took that and stuck it away for future use, right? And so, my team today is they'll hear me say things that I'm repeating after the gentleman I'm talking about, right? And so,
are we going to share his name, or are we going to share?
Yeah, I will, absolutely. His name's Gary Inman. Yeah.
Gary Edmond.
Gary Inman. Mhm.
Inman. Okay, great. Thank you, Gary.
Yeah. So Gary instilled a lot in me, not just in the construction space, but just in the avenues of doing business and management and banking, and then just in life in general. Matter of fact, I'm meeting him in September for a fishing trip, and he's retired and get to go visit with him again.
That's awesome. I don't know what I would do without, some of the mentors that I had growing up, just so influential. Now, knowing that, how have you, taken this information and, are you mentoring anybody today directly, or how are you sharing the wealth?
Yeah, I think so. I think that we just try to take the things that we know nowadays, and such as having a great opportunity to join the management team with Luminate Bank, and the owners of Luminate, Karen Reuter and Eric Levins, the major shareholders of the bank, invested in this opportunity, and they see the vision, and they saw that a construction division that is run in the appropriate ways becomes a major leverage for a bank. It becomes a good revenue stream for a bank, in addition to the other revenue streams that are present in banking in today's world. And so we just took that knowledge and kind of leveraged it. And today I've got a team of about 14 people that work with me, from originators to operations personnel to construction administration, that helps us manage the day in, day out functionality of the construction division so that we can scale it on a large national basis. And that's where I instill in them some of the things that I feel that help them be better at what they're doing as well, because I was in their shoes at one time. Yeah.
Yeah, it's kind of love teaching and passing that information on. You mentioned, that this is an important revenue stream for the bank, and it could be very important. And one of the things that I like to think of is, hey, with the absence of, what's the impact if this program wasn't there, right? Or if your bank goes 20 years and has done really good, and then one day somebody decides to pull the plug, what are the implications of that to the bank, to the people there, to the community that you serve? What happens when you don't have it?
Yeah. And, I think that's a great question. To start something up, it's not inexpensive. It costs money, right, in today's world, and nothing's cheap. But once you have scaled it and you have it running appropriately, it becomes a machine. And if you have the right people doing the right jobs, then it is a good opportunity for an organization that wants to be in construction lending to generate additional revenues above and beyond your traditional origination and gain on sale of loans and things of that nature. It's going to present, in addition to originating the loan and loan fees that you get from that, to interest earnings during the construction phase, to fees that are involved from a draw perspective, to selling that loan and getting gain on sale at the end of the day, to servicing. So there's a lot of different avenues. I call it another leg on the stool. So you may have the construction division, you've got the mortgage division, you've got the banking division, you've got the commercial division. All of those are good legs on the stool that keep you solid. And sometimes one of them performs better than the other, depending on the time of the year. But at the end of the day, they're all supporting the entire organization and the foundation of the stool. And it becomes just a great opportunity. Can that go away? Absolutely. Or can it become difficult? Throw a COVID in there. For those of us that were in the construction business or just in the mortgage business in general, everybody felt that pain of COVID, right? Materials got very expensive. Our average time under construction went from 275 days to 540 days during COVID.
Wow.
And so you have to have a contingency plan. We call it DEFCON 5 is what I call it. And so we go to our contingency plans, and that's a part of understanding what type of construction lender you want to be. So from a smaller lender to a larger lender, if depending on how many units you want to have under construction, and you've got to have these contingency plans in place. So COVID was one of those situations that took a lot of this away from banks. Borrowers couldn't finish their homes. And then if the bank didn't have a plan in place on how to step in legally and be able to assist that customer getting to the finish line, or have other opportunities to refinance and increase budgets to handle cost overruns, or whatever the story may have been, it became very expensive for banks, where it could have been a large loss of funds, hence going away at the end of the day, right? Some banks or mortgage companies, IMBs, might not have been able to weather that storm. that way. So you just have to understand what your risk is. If it goes this way, what do we do, right? If the builder fails, how do we step in and help? If the borrower fails, how do we step in and help? I attribute that all the way back to our residential construction loan agreements that we put into place right off the bat to help us have a good, secure loan that identifies who's responsible for what. And in the event that we have challenges, we have a pathway to follow.
No, I love it. I love it too. It's, and you even kind of dived in the beginning, kind of the direct, hey, here's the direct areas of revenue impact where these are the things that are growing. And then, you started to talk about the different legs of the stool. And one of the things that kind of that made me think of is, there's also this indirect relationship of revenue, and you being a bank, and I only bring this up because I've got some really good experience of working with a large commercial bank and one that had pulled out of construction lending, and they thought it was going to be, a certain hit. They had, taken their balance sheet and gone, hey, here's what our hit is if we pull out of construction lending, and a year later they were, somewhat frantic of wanting to get back into it. And that's where kind of we entered the conversation of helping them scale back in. And what I had never considered, which is what really drove the conversation, it wasn't what they had identified in the direct revenue impact. It was the indirect revenue impact that far surpassed their expectations of the builders that banked with the bank. The loan originators that originated construction loans that left the bank to go work for somebody else that was going to let them originate construction loans. They also originated other mortgages as well and refinanced other people as well.
Yeah.
The deposits, the lines of credit, all these other lines of businesses were directly impacted by the decision to exit construction lending. And I think that goes in reverse as well, as when you decide to, to grow that or to foster it or to nurture it, those other areas of the banking, revenue centers start to grow because of those symbiotic relationships. And, I'm not sure if that's what you were kind of leaning into on the stools, or if it was more kind of a risk balancing situation, but that kind of came to mind and I put a little note of that. Is that?
It is, because construction leads you down a lot of other pathway opportunities, such as a recruiting opportunity, right? Just like you spoke of on the loan officers. Construction programs give the loan officers the ability to go out there and build additional relationships they might not otherwise have with builders and realtors and borrowers. And if that's not available to them, some people make a choice to maybe do something different, different organization, just as you identified. So those could be some of the negative impacts, definitely, of not maintaining the construction division, or if a construction division went away, and as well as the different other opportunities from depository standpoints and lines of credit. I mean, you hit it spot on, John. So it's ever reaching. It can go a lot deeper than just saying, hey, we don't want to do construction anymore.
I mean, you also mentioned, about COVID and kind of some of the lessons that you learned from COVID. How much of that experience plays into the way that you're developing this program now?
It's really large. I'll be honest with you. We're a very flexible construction lender now. We want to be, very user-centric for our borrowers and our builders, but within certain parameters and guardrails that we have put into place. But it's driven the way that we've defined how we're wanting to lend on certain programs, such as, a lot of life happens in 12 months. So I like to work on construction programs or homes with a 12-month build time or less, because in 18 months or 24 months, as you can see, there's a whole lot of things that can happen. You can have a pandemic, you can have a natural disaster. The borrower can have problems, the builder can have problems, and this is just life in general. And that can happen in 12 months too. But we like to focus our programs on things that we can do in 12 months or less. Is traditionally there. We're focused on affordable housing, for us. That fits in that 12 months or less type building opportunity as well. We're focused on being very transparent and clear prior to the loan closing on the responsibilities of the borrower, of the builder. We lend to the borrower. The borrower picks their builders. They're licensed builders if they're required to be licensed in the state and insured. They pick their builders, but we make it very clear through education on the front end to the borrowers and the builders about the programs and the responsibilities to start and finish the programs, and then how we fund that process and maintain that draw procedures throughout that. And so I think that's a big piece of that too. So, coming out of COVID, it has had really identified Also, two other strategies that, okay, what happens if this builder fails? What do we do then? Right. Builder A, just any builder, right? And so we've put some practices in place that says, okay, from our draw administration, the thing about that is that they're very knowledgeable. They listen. They hear what the borrower is saying. They listen to what's going on with the builder. We've got parameters in place that say if we haven't had a draw in 60 days, hey, we're just calling to check up on you, make sure things are going well, right? We want to know that everybody's still moving forward. It's difficult for borrowers and builders. By the end of the day, the borrower is going to pick out every little thing that goes into this house working directly with the builder. And so, we stay focused on the shiny things that pop up, during the construction administration, and just make sure that we're listening intently, because when you have a builder call you and say, hey, I need you to fund my subs for me, you're too late at that point. We should have been listening way before to the borrower saying, hey, the builder's not showing up. I can't get a hold of the builder, right? So little things like that. And that started happening and really became evident in COVID. We had a lot of builders have challenges, so we had to work through those things. And so education on the front end is huge with this. And then listening, having a team that's got the right people in the right seats that can help understand the process all the way through, I think, is some of the things that we really learned out of COVID.
Oh, that's great to know. So these are all, C2P or construction only. What do you, one time, 2-time close is?
Yeah, it's a mix.
Yep. Okay, it's a mix.
Yep, FHA, VA conventional one-time closes, and then just a 2-time close interim construction loan.
Okay. Any special features you guys are building in, or?
Yeah, that's something that we did a little different here when I came to Luminate. One of the things that I learned, just as some nuggets, is that borrowers like to have options, at the end of the day. And in today's environment, it's not cheap to build a house. It's expensive. The cost of building a home has gone up. First-time home buyers are spending more than they ever have on their first home and things of that nature. And so we wanted to make it, again, a focus of ours is affordable housing, right? So we've really adopted, in addition to our interim construction loan, but the lower down payment, higher LTV transactions for VA, FHA, and conventional, but then providing options there for the borrower that says, hey, you know what? There's an interest reserve account here. If you'd like to build in an interest reserve account, we can help you with that, right? Where you don't have to have any physical payments during the construction phase of the loan. We have a reserve account over here for you. We can draw it out of that account. That'll help them financially not have extra expenses on top of their current living expenses during the construction phase, because everybody's got to live somewhere and rent or mortgage or whatever they're doing. We do the same thing from a contingency type situation. We allow the borrowers to build in contingency. We don't require it, but working with the builders, we allow them to do that and then help them manage those funds with change orders, upgrades, unexpected expenses. And then in addition to that, from a loan fee standpoint, we have the ability for the borrower to account for loan fees and their overall cost of construction on some of the programs. It's available to do that, which then reduces their out-of-pocket funds at the time of closing. And so it's kind of a buffet of items. Here's all the construction loan programs that we can offer. You're going to fit in one of these for sure. And then how do we need to structure the loan that is most beneficial for the borrower, that helps them, during the construction phase, not be overwhelmed financially, and then make it an easy process for them to walk through that with our draw administration team, through the inspections, understanding their statements, understanding the processes and how that works, because it's new for them. Most of the people have never built a house.
I like it. Construct your own construction loan. And which features tend to be the most popular or least popular? What are you seeing so far?
Actually, the construction management fee, 90% of our customers include the construction management fee into their overall cost of construction, because it helps reduce their funds to close at the time of closing. So the origination fees and processing and underwriting fees and stuff like that are not charged if they're including the construction management fee. And then it's the interest reserve account. The interest reserve account is definitely a useful tool. The borrowers on a VA loan can't pay any fees during construction anyways. So then the VA allows an interest reserve account to be set up for a borrower so that we can then draw from there versus the builder having to pay for it on a monthly basis as it used to be. So, but that's probably the biggest two. And then we do have now quite a bit of people doing at least a 1% contingency. It's very little money. It's not large, but what they're using it for is at the time of modification to permanent, there is always some form of small expenses that come up of interest payments that are due if there's interest not left, or Maybe their homeowner's insurance cost a little bit more to bind at the time of modification. Maybe they had some change orders they need to take care of with the builder. So we're seeing that's been pretty helpful too. But about 90% of our customers use almost all three of those opportunities.
Now, how do you manage the contingency? This is a question that I get asked a lot, so I'm really curious your answer. You've let them roll in a contingency account. How do you manage that to make sure it goes towards important stuff versus, hey, we're at draw one, and by the way, we just added a pool, and it's like, whoa, hold on.
Yeah, we wouldn't. That would be a big change. Yeah, so that would be a pool is a different ball game. While we do allow pools, it's included in the overall cost of construction, managed by the builder through the pool company as a subcontractor. But from a contingency standpoint, it's truly just for those unexpected things between the borrower and the builder, right? The builders build a contract. It's a fixed cost contract that we're working on. And that's how much money they have at the end of the day. Builders are not perfect. Prices change. The industry goes up and down depending on what's happening. And so, they'll come and say, hey, I need to access my contingency account. I need to pay for these items here. Okay. As long as it's not affecting our transaction in a negative way from an appraised value standpoint, we're not changing the footprint of the proposed construction appraisal that we did up front, which is what we're lending off of, the appraised value and the total acquisition cost. And so typically they're going to 99% of the time be, I want to upgrade my countertops, or I want to change the flooring, or I want to do those things type of situation. And we're just saying, hey, we need to see the change orders. We're not necessarily approving the change orders, but unless it's on a C to P, we do require that we see those and then approve those, because we can't change the footprint of the house or the square footage or things of that nature. But we do ask just for those, and 99% of the time they're accessing for those types of items, just finishes and upgrades.
Makes sense. It's funny how some of these little details all start to kind of come together and can be really beneficial or start to hurt you if they're, mismanaged. But, we started the conversation before we hit the record button. And, I'm going to kind of bring up that same conversation that we had, because I just find it so fascinating. And, we share information all the time, and, we're kind of plugged into all these different news feeds. Absolutely love home builders associations and the information that they share, and National Home Builders Association. I mean, they just do a great job. And one of the kind of interesting pieces of information, and I kind of, will describe this as an onion, because I think the first piece of, housing news was residential housing market was softening and housing starts were down. And it's like, oh, that's kind of interesting. I was like, but it really doesn't match with what we're seeing. And I think a week or two went by, and then got another article from them that says, oh yeah, it's actually commercial is up and residential down. And I was like, oh, okay, maybe that's why we're seeing, a lot of growth right now. And, maybe it's skewed a little, but it really doesn't quite fit. A couple more weeks go by, and just read one this week about custom home builds are, up 30%. I was like, that makes a lot more sense, where it's like, hey, big production home builders are down, but they're kind of weighting the scale, which kind of distorts the information. So without all of that context, it really doesn't quite match what I was seeing or what I was feeling. And, just kind of curious, how are you feeling the market conditions? Does that information align with what you're seeing? What are you hearing out there?
Yeah, that's a great question. The data is good information, obviously, and it's all encompassing of commercial, residential, multifamily, single family starts, and things of that nature. From our perspective, I think some of the production builders may be seeing some slowdown in starts. Obviously, there's a lot of inventory that has been available out there that may have not been moving for a production builder. They're on the ground, but due to rates or insurance or whatever the factors are, they're just not moving as quickly as they like from a production builder standpoint. And there's avenues that production builders are working with to try to increase those opportunities for borrowers through better interest rates and just different things that they can do with their lenders, right? But from our perspective, we're building custom and semi-custom homes. So we're working with builders, and this is kind of where I kind of lean back on what kind of construction lender do you want to be, right? We're working with builders that build 2 or 3 houses a year, to builders that build 100 houses a year, right? That are semi-custom builders, right? And they, or the full custom builders. So we continue to see our pipelines are growing. We put our programs out here and made them available in addition to our interim construction loan with all the agency programs. it's just giving our loan officers a tool to get out here and get in front of these builders and borrowers that they didn't necessarily have all that before. And we're seeing opportunities come about because I think borrowers have been looking, that borrowers that are looking to buy, they've been looking, and maybe they're not finding the house that they want. Maybe they're a first time home buyer and it's a $400,000 or $500,000 home that's 30, 40 years old, right? That is going to have challenges, and a first time home buyers, that's tough on budgets, right? So we're seeing that our business is growing, especially in the affordable housing sector, using the agency products. Higher LTVs are allowed, lower down payment requirements. We give options to customize our construction loans to help the borrowers, be able to buy a home, buy some land, build a house, live somewhere else, and then help them manage through that process. And we're seeing that demand is continually growing. Fannie and Freddie are supporting, the construction models as best as they can from site built and factory built housing and helping from those perspectives. And so we're not slowing down. So for those that, may be seeing it from reduced starts and things of that nature, I just think it depends on what kind of builder that is. But I think a lot of the custom guys are still moving forward fairly quickly and are doing well, at least from our perspective. We're building all across the country right now.
You mentioned something in there. You were kind of saying about almost affordability challenges, right? What are you seeing that are the challenges for those that are out there looking to buy a home today or find a home or build a home? Like, what are the actual challenges they're seeing? Is it interest rates? Is it availability? What are you hearing?
I think it's still bouncing back to interest rates and insurance cost for the most part. There's been many states where a lot of insurance companies have pulled out.
Yep.
Florida, Texas have experienced some of that.
California.
Yeah. The natural disasters that have hit across the country are impacting new construction that we're going to have to rebuild, right? It's just how do we rebuild and how fast can we rebuild for folks? And then what's the cost of that going to be, right? The floods, the fires, all of these different things have an impact on construction lending in the business that we're in. And so, I think that interest rates have gotten better, which is good, right? There is opportunities to lower interest rates through different programs out here nowadays and buy downs and discounts, and builders are using forward commitments to help, on a production side, if that's helps them move their product. But I still think that that's our bigger challenges. And then now some of the homes that are just in an older capacity that need upgrades and updates from a renovation standpoint, you're buying a $400,000 house that needs $100,000 in renovation and you're a first time home buyer, that's challenging for somebody, and maybe they're not going to renovate it. And then you've got pipes and old mechanicals and things like that break that, first time home buyers may not be used to. That's where I see the factory built world really taking off, your manufactured and your modular homes, because first time home buyers, these are $300,000, $400,000, $500,000, depending on where you're at, from a manufactured modular space, built in a factory, climate controlled, brand new, brought to a property, comes with warranties and all of those things. And I see that a lot of first time home buyers are stepping into those types of properties versus a site built, an existing site built home, or maybe they're building a site built new construction house that still has the warranties and the builder's warranties and all the mechanicals warranted for that person that's never really owned their own house before. Right.
Even the MH Advantage, where it's like the hybrid. Hey, this looks like a stick built home, doesn't have the flatter roof. It has a peaked roof and a porch and looks almost identical. You can't tell the difference, and those are phenomenal.
Yeah. Well, and now you can put those in city limits. So they're not considered manufactured. They're cross modulars, right? Modulars are
comps,
with site built houses and stuff. So there's advantages of that are helping. Yeah.
Oh, that's great. What else are you seeing out there? Any other challenges that, let me say it like this, as we get out our crystal ball, we've heard about rate cuts, end of the year. They've kind of postponed it. There's kind of like the political fighting that's going on between Jerome Powell and Trump, right?
Yeah.
But it does look like we're going to have some sort of rate cuts at the end of the year, which we're getting close to the fourth quarter. How much of an impact do you think that that's going to have for first-time home buyers or, construction lending in general? We see a half a point, is that going to move the needle?
Yeah. I don't know, Sean. I don't know how to comment on that one. I'll be real honest with you. We all know that, that federal prime rate doesn't necessarily drive our mortgage rates, but there's always some positives or negatives that associate with the movement of the federal prime rate somehow to the mortgage industry. So I don't know if it's, I think any interest rate improvements will be helpful across the country in anything that we're doing right now, from commercial aspect to credit cards to any of these things. And if it can make life better, that's fantastic in any way, fashion, or form. But from a construction standpoint and a residential lending standpoint, I'm not sure the impact that it will have. I like you, I've been through cycles and just seen things go up and down, and it's kind of a see it, set and wait type. I wish I had the crystal ball, like you said, and I do, but I just don't have it. I don't have a great answer for you on that question.
I'm excited. I think things are going pretty well right now, but I think if, as we start seeing, some sort of downward trend on interest rates, I really think that that's just going to get some buyers off the sidelines. It's going to signal, better economic outcome. I think there's a lot of positive things that, when they start going in a controlled manner and predictable manner, we start seeing good things happen. And that's pretty exciting.
Where one place you might see some improvement is for the lenders working on warehouse lines.
Yep.
So that federal prime rate affects a lot of the warehouse lines from a commercial lending aspect, right? And so any improvement in that has got to be helpful on your cost of funds for your transactions and things of that nature. If you're not a bank and you're an IMB, that can definitely, I can see where that would be very helpful from that, and maybe from an interest rate perspective on what rates they offer, moving forward for construction lending.
This has been awesome, Cory, and having you on the podcast is absolute pleasure. If somebody wanted to get in contact with you and reach out and kind of pick your brain on something or ask you a question, what's the best way for them to get in touch with you?
Email or phone is the easiest way to do it. I can share my phone number if you guys are fine with that. It's 817-538-2735. And then my direct email is Cory.Bearden, Bearden, @luminate.bank.
Oh, that's fantastic. And we'll go ahead and include that information here with the podcast. But pleasure having you on today, and hope to have you back soon.
Best, Sean. Thanks for having me. It was a lot of fun.
Have a good one. Thank you, Cory.
This podcast is intended for educational and informational purposes only and does not replace independent professional judgment. Land Gorilla Inc. makes no representations, warranties, or promises for and disclaims any express or implied warranties related to content. Before acting on any information, you should consider the appropriateness of the information as it pertains to your unique business needs.